This meeting is
we
being
can see.
recorded.
Okay. So when you look at the screen or in the hierarchy that we have different portfolios. And as I've mentioned, we are creating these portfolios to ensure that the income or the interest that you're getting is able to cover for your various needs. So for example, we use the bottom portfolio. We are looking at things like food, clothing, and shelter. So the mindset was, if you depend on your salary or if you depend on your business, you'll have seasons where your business is not doing so well. You'll have seasons where you may lose your job, or you may have seasons where you'd want to transition from one job to another. But you remember, in this day and age, you still have to cater for the basic needs. And these basic needs, you're talking about the food, clothing, and shelter. So the lifestyle portfolio, we sit down with you and a client and ask, right now, for example, your monthly expenses are 40,000. So in case you lost your job, you still need 40,000 to cater for your food, clothing, and shelter. What kind of portfolio do you need for you to be receiving 40,000 in terms of interest on a month-on-month basis? So when we're able to figure it out, we're able to work towards that goal, such that if you're in business or if you're employed and at one particular time you lost your job, it means that your lifestyle will still be sustained. So we move to the next portfolio called the security portfolio. You're still thinking of having the same mindset. You want things like education for your children, healthcare, the premiums that you pay for your insurance, home ownership, all this you want to be paid or catered for from the returns. So essentially you're building passive incomes. And anything that we know about building a house is that the foundation is the strongest. So in the case that you move all the way up and go to a portfolio such as aspirational portfolio, and in this case, maybe buy a luxury car, and God forbid you lose your job, it's very easy for you to come all the way crashing down and you're not able to cater for your basic needs. So that's why it takes a bit of time for you to build up that lifestyle portfolio. It takes time for you to build up that security portfolio. And at some point, you may find that you may never get to the aspirational portfolio, or it may take you a very long time to get to the aspirational, the legacy portfolio, because the foundation takes quite a while for you to build that portfolio. Yeah. So essentially, investing with purpose, we want to sit down with you and a client, figure out what's the goal that you want to achieve. Some people have a goal of owning a home. Others want to pay for their children's education from the income that they're getting. Others want to build an emergency fund. So we sit down and say, you need this home in the next 5 years. We are starting at point X. How much do you need to put towards your portfolio in the next 10 years, given a certain level of risk and return for you to build that portfolio? So essentially, that's the whole aspect of investing with purpose. And before I proceed to the how, I'll take any questions we have regarding the why, the goal. Might we have any questions on this? Any on this screen? Okay, so I'll proceed to the next aspect. So we've already identified the goal. Say, for example, Eve wants to build an emergency fund, for example, and we all know an emergency fund. These are monies that you want to access in case of an emergency. So we do not want to lock in these monies. We do not want to invest these monies in investments that are high risk. And this is where the unit trust comes in. As I've mentioned, we are licensed by the Capital Markets Authority, and we invest on behalf of both individuals and institutions. And one of the funds that we have right now is the money market fund. It's become quite familiar during the COVID seasons, because investors and Kenyans in general are looking at the savings at the bank and seeing that inflation in Kenya keeps rising, yet the savings that you're saving at the bank keep depreciating because of inflation. And this is where the money market comes in. The money market one is it's an alternative to having your funds at the bank, with the benefits of earning interest on a daily basis, compounded on a monthly basis. In case you wish to access your funds, you can do so within 48 hours. And the returns that you're getting currently, the money market at NABO is giving 9.3% per annum. Last year, we closed our books at 9.5, and this is net of management fees, gross of tax. So anyone who had invested with us from January till December got an average of 9.5%. And we invest the same in dollars. Dollars right now is giving 2.06% per annum. Last year we closed at 4.5, still net of fees, gross of tax. Now for this fund in particular, for anyone who is looking for a short-term parking bay for the funds, other than having these funds at the bank where the funds are not earning interest, you can use the money market as a parking bay. So for example, you have business and you need money from time to time to stock up, or you're building up that emergency fund that I've mentioned, or you need to make some payments within the month. Other than that, having that money lie at the bank, take advantage of the returns that the money market offers, and you're able to preserve your capital and still maintain a degree of liquidity, meaning you can access your funds within 48 hours. The second fund that we have is called the Fixed Income Fund. Yes, please.
Sorry for interrupting. You
No
said
problem.
it's net of fees, gross of tax. If you are to
Yes.
deduct the tax, what is the effective rate?
So you can do 85% of 9.3. Let me just see how that comes to. Right now it's giving 9.3. So net is 7.91. Net of fees, net of taxes.
So the effective rate is 7.91.
Yes, 7.91 net of fees, net of taxes.
Okay, thank you.
Okay. So the second fund we have is a fixed income fund. So what will differentiate the fixed income from the money market is one, the underlying assets or where we're investing the funds. The money market, you mostly invest in government treasury bills, deposits with banks. The fixed income, you're focusing mainly in bonds. That's the treasury bonds with the government. We have a bit of it in deposits at the banks. So the main difference would be the fixed income funds are locked in for a minimum of 6 months. Interest is also earned daily, compounded monthly. In terms of returns, right now it's giving 11.06% per annum. That's net of the fees, gross of tax. If you were to do net, that comes to 9.40. So net of fees, net of taxes will come at 9.40. Last year we closed the same at 10.5 average. And in terms of the US dollar, we closed at 4%. So in terms of the needs that the fixed income, majority of our clients who are here are looking to build longer term funds. These are funds that you want to invest for the next 2, 3, 4 years, and mostly they're towards bigger goals, such as you want to supplement your retirement plan, or you want to grow an education plan for your children, or you want to build up a home ownership. And because of the consistency or the stability of the returns that we get from the bonds, the fixed income is most preferred. So even as we create a lifestyle portfolio for you, this will be the funds that we use. So on average, the lifestyle portfolio will give you between 10.5 to about 11.5% per annum, net of fees, gross of tax. Might we have any questions on this?
Yes, I have a question.
Yes, please.
You said that the underlying, investment is what do you call it? Treasury.
Bonds.
Yeah. So I was just wondering, there is no tax incentive that comes with this particular fixed income fund because some of the bonds themselves are tax exempt. Okay.
Now, when you're dealing with a portfolio or when you're dealing with economies of scale in terms of the unit trust, you're buying bonds that are both tax exempt and taxable, yeah? So when we combine it as a portfolio, we're not in a position to separate the two. Because essentially what we're doing is if you go buy a bond directly, you'll be locked in for the 5, 10, 15 years, yeah?
Yes.
But in the fixed income, we're telling you for the first 6 months only, you cannot access your funds, but you're getting a return of 11%.
Okay.
And the way the funds are structured under CMA, it has to be taxed 15%, irrespective of the bond that you bought.
Okay, fine. And then you mentioned that for the fixed income fund, interest is earned daily, but compounded monthly.
Yes, similar to the money market fund.
So my question is around this annualized rate, the last column on your table.
Yes, please.
The annualized rate already factors in compounding.
Yes, when you look at, for example, 2021, when we say 11%, this 11% is annualized, right?
Yes.
So on the tables, what we try to do is give the rates month on month on month. So for example, in 2020, when we closed at 13.2, that was the effective annual return. So anybody who came in Jan and exited maybe in December got 13.2 net of fees, gross of tax. So in 2021, if you came in Jan and stayed all the way to December, you were at 10.5% net of fees, gross of tax.
Okay, understood. And then my last inquiry, I don't know, I might be preempting your presentation. Are you planning on talking about the minimum investment into each of these funds?
Yes, please.
Okay, so then let me not preempt. Thank you.
Okay. So in terms of the nature of the investments, I've mentioned the two funds that aim to preserve the capital. That's the money market and the fixed income. And in terms of risk, they're regarded as low risk because we're investing with the government. So I'll move to the more moderate risk and high risk. Moderate risk and high risk is because when you introduce an aspect of shares, there is a volatility in the market. And in these particular funds, your capital is not assured. Unlike the money market and the fixed income where your capital is preserved, these two funds, the capital is not assured. So balance fund is I would say it's a combination. You're investing in bills, you're investing in bonds, and you're investing also in shares. Now, because we've introduced that aspect of shares, as I've mentioned before, the capital is not preserved. And for this fund in specific, we advise for you to invest if you're coming in for a long term. That's about two to 5 years. You're coming in with a long-term mentality and you're looking for capital growth. Okay, and in terms of investments at NABO, as our MD had mentioned in that interview with Rina, we also invest in markets outside Kenya. And mostly this is in the shares market. In the equity fund, we invest 100% in shares. So in terms of risk, it has the highest level of risk. The timeline is we advise for you to come in for a period of 5 years and above. And if you're looking for capital growth, so if you're looking for capital preservation, you're looking for low risk, low return, the money market and the fixed income. If you're looking to invest in shares, but you may lack the technical know-how of buying the shares directly, you can come through the NABO Income Fund, where we invest in these shares in both Kenya shillings and in USD. And the goals for the two are different, yeah? Any questions on this? And now we go to the fund comparison and where we mention the minimums.
Sorry, maybe if I can just interrupt you.
Yes, please.
Maybe just a comment on the USD funds versus the Kenya shillings fund and why one might opt for one over the other.
So when you compare the Kenya shillings and in USD, first to point out obviously is the difference in currency. So if you pay your bills in Kenya shillings, if you're paid in Kenya shillings, if you're looking for a higher return, Kenya shillings give higher returns. If you're looking to diversify your portfolio and have it in USD, you can opt for USD. Or alternatively, you find that you pay your bills in USD or you do your business in USD. It would be advisable to put it in USD, but from our comparisons over time, if you're investing in Kenya shillings, the returns are always higher. If you compare the money market, Kenya shillings is 9.3, USD is 2.06. Income-wise, Kenya shillings gives better returns. But there's also that aspect of the exchange rate that you need to consider, especially given that the Kenya shilling is weaker than the dollar.
Sorry, for the risky funds, what are the rate of return the last year or two?
Now, when you're giving with the balance fund and equity fund, it's difficult to give a rate of return because you're dealing with stocks. It's difficult to say we got maybe at 9% for this year, but for 2021, for equity, we were at -4%. And balance fund, I believe, was -2. The equities were not performing as well. I can proceed to the fund comparison.
Yes.
Okay, so we've categorized our funds based on the risks. Low risk investments are the money market and the fixed income. We do not invest in shares in either of the two. Asset allocation is between bonds, bills, and deposits. We do not have any initial fees. We do not have any redemption fees for the money market. For the fixed income, you have a redemption fee of 0.25 in the case that you withdraw before the first 6 months. And this 0.25 is on the rate. So right now we are giving 11% on the fixed income. If you withdraw, say, in month 4 or 5, you will get 11% less 0.25. So that will be 10.75 net of fees, gross of tax. Annual management fee, we are allowed to charge all the way to 2.25. But right now we're giving about 2% for the money market and the fixed income. And our rates are net of these fees. Minimum recommended holding time for money market is 3 months. For the fixed income, it's 1 year. Then when you go to the minimum initial investment for the money market and the fixed income is 100,000. Minimum initial top-ups are 10,000 and above. So for you to start investing in either of the two, the minimums are 100K. For balance fund and equity fund, the minimums are 1 million. In terms of risks, the balance fund is moderate. There is shares involved. We invest in bonds also. So for the balance fund, you have an initial fee of 2%. So if you decided to invest, say, 1 million in the balance fund, 2% of it will be management fee. So we're going to invest 980. The redemption fee will be 0.25 if you redeem before the first 3 years. And management fee is all the way up to 2.75. Currently, it's at 2. Minimum recommended holding period for balance fund is 3 years. Equity fund is 5 years. The same applies in terms of the fees, redemption fees, and annual management fees. I believe I've captured, I've highlighted the minimums. Minimums for balanced equity fund is 1 million. Minimums for money market and fixed income is 100,000. Minimum top-ups for money market and fixed income is 10,000. Minimum top-ups for balance fund and equity fund is 100,000. So what happens in the case that you've decided that you'd invest with NABO Capital? There's an application.
Can I just interrupt you?
Yes, please.
I had looked at your fact sheet for the money market fund, and well, maybe not the recent one, but previously it has been stating that the minimum, I think, is 1 million, rather than the 100,000. So if let's say, for example, some you are having a group coming in, let's say a chama, is there a minimum, the 100,000 or the 1 million?
It's 100,000. 1 million applies to institutions. We use the same application forms. So for individuals, against the 1 million, there is a slot where you indicate how much you're starting with.
Okay, thank you.
I hope I've answered your question.
Yes, and then just to be sure I understood you right, the redemption fees only apply when you don't meet the minimum times. The minimum.
Yes.
Yeah.
So for the fixed income, the funds are locked. They must be locked in for the first 6 months. Yeah. So if you withdraw, say, month 4 or 5, you'll be penalized. But if you withdraw on month 8, 9, there are no penalties. Balance fund the same. If you withdraw before the first 3 years, there'll be a penalty. If you withdraw in the year 4, there is no penalty. The same with equity fund. So you're only penalized if you redeem before the period ends.
Okay, thank you.
So in terms of account activation, we have application forms. We require a copy of ID and KRA certificate. It's good to mention that the returns are final taxes. So we file the taxes on your behalf, similar to how you treat tax on your normal savings account. Is the same way you apply to the same if you're an individual. Upon filling the form and sharing it with us, we share with you bank details for you to fund your account. Upon receipt of the funds, we'll share with you a receipt, a welcome letter that shows your membership number, and all this communication is done via email. So even in the case that you redeem, we can only send funds to your bank account. We currently do not send any monies on M-Pesa. We are also finalizing in terms of creating a customer portal that will allow you to interact with your statement on an active basis. In the meantime, you communicate to us through emails. And yes, that's on my end. We treat differently for clients who are coming to invest directly in the funds, and as opposed to those who are coming in through the portfolios. Now, for the portfolios, we create we create an investment plan for you as an individual. Sorry for that. So for clients who would wish for us to set up a portfolio dependent on your goal, we are able to come up with proposals for you. We're able to sit down with you and identify the particular goal, see how long, discuss on the timelines, and discuss whether it's achievable or not. And that is all in the Investing with Purpose plan. I don't know whether we have any questions on either.
So maybe what we have are some comments.
Okay.
If you're done, I think the members are free to unmute themselves and ask. But in the meantime, I can go through what is in the chat section. So we have Paul asking why the big difference in returns between the USD and Kenya shillings.
Okay, so the difference between the returns in USD and Kenya shillings are also dependent on the inflation rate. So for example, USD, we relate it to the US. In US, inflation is between 1% and 2%. In Kenya right now, inflation is at 5.80. So even in the case that you're given 4% for a dollar, it's inflation adjusted, as opposed to Kenya, we cannot give you a return that is less than 5.8. The big difference mainly come in with the difference in monetary policies between Kenya and the US in those terms, and also when you consider the inflation in both countries. Paul, I hope I've answered your question.
Yeah, I think that's okay.
Okay.
I'll need a bit more education on this, but probably some other time.
We actually have a video on YouTube. We have one of an investment analyst that gives a difference. You can have a look at it on YouTube, the difference between investing in USD and Kenya shillings. You can have a look at that.
The channel is, what's the YouTube channel?
Nabo Capital.
Nabo Capital. Okay, thank you.
Yes. Okay.
Yeah, so still related to that, Kenya shillings versus USD, we have Elizabeth who's saying that interesting that the Kenya shillings would give better returns than the dollar. Would have thought that the stability in the dollar would be an advantage to the investor. So I think I'm with her on this one, because in my layman thinking, I would have imagined with the, what do you call it, with the currency risk. You see, like we've had the devaluation of the Kenya shillings, that devaluation in quotes would be a gain if you have a dollar denominated investment.
What I can do, we'll do that calculation. We'll make an assumption that we have two clients who are investing 100,000, both in Kenya shilling and in dollars. And that's in the fixed income USD. I hope you can see my screen.
Yes, you can see the Excel sheet.
So we'll start with the 100,000. Let's make the assumption that client A is investing 100,000 in fixed income Kenya shilling. Right now it's giving 11.06, yeah? So net of fees, net of return, that comes to 9.40. So on average, this client is getting an average of about 786 per month in terms of return, yeah?
Yes.
So the same client decides to invest in dollars, that's $1,000. And that's $1,000. And the average return is 4.5. On average, if you invest in dollars, you're getting $3. So 786 vis-a-vis 300 shillings, that's a very large difference, yeah? So the main question would be, would you prefer to hold it in dollars and hope that the currency exchange will cover for that return? Or would you rather invest in Kenya shillings, take advantage of the returns, then convert back to USD? And that's something that one needs to sit down and think about. Comparisons of returns vis-a-vis the currency exchange. But in my opinion, the Kenya shilling gives a return way higher. You can decide to diversify your portfolio, have some of it in dollars, have some of it in Kenya shillings.
There's still an additional question from Elizabeth. She's saying, is there a chance that the penalty would be more than the income generated within the period before the premature withdrawal? Mm-hmm. That is, will the investor end up with less than they put in by withdrawing early?
For the money market, for the fixed income, not, because the penalty is not on the principal, it's on the return that you are supposed to get. So in this case, you are supposed to get 11%, yeah? Mm-hmm. But you withdrew before the 6 months. So you're going to get 10.75 instead. So the capital is still preserved, mm-hmm. but the return has reduced.
Okay, you've mentioned that if you're withdrawing at the 11th month, did I get confused? Because I think you said fixed income minimum is 6 months.
Yes, 6 months.
So why is there a penalty at 11 months?
It's a penalty if you withdraw before 6 months. There are no penalties after 6 months.
Okay.
Yeah.
So
Yes, Elizabeth?
I have a question on the equity and the balanced funds. I'm just mm-hmm. curious why people would invest in them. Is it that in the past they really have very good returns, like mm-hmm. I don't know, 20, I don't know. So do you have an idea why would people go to them? In terms of
why would a client prefer the balanced fund and equity fund opposed to the money market and the fixed income?
Yes, yes. Have they ever gotten very good returns, or why would people go there?
So you'll notice there's a particular year, I believe in 2012, where they did 28%. The thing with anytime you're investing in shares, it should be a long-term game. So if you're investing in shares or anything that has shares for a period of 1 year, 2 years, it may not be the best decision. So if you're coming in to invest with a long-term mentality, and there's always that trade-off of high risk, high return. So we do have clients that understand the equities market very well and are comfortable with the high risks that in a particular year, you may have less of what you invested, but you need to be patient enough for you to cover that risk. So you need to look at the risk profile, how long you're looking to invest, as well as the asset class.
So it's possible that in 5 years you can get more than 10%?
Yes, it is, but it is not assured.
Okay, no problem. Thanks. Mm.
Unless if we have any more questions.
Okay, I think I have the question because okay. Unless my understanding is incorrect, you are maybe one of the few or the only fund that is allowed to invest externally. So then my question therefore becomes why your equity and your balanced funds, in quotes, are not a little safer, if I can call it that way, simply because you have a wider market in which to invest. Others may be restricted to Kenya, but you're playing on the continental front. So, okay, I'm struggling to understand that. Okay, so the returns will vary. If you look at the NSC, last year we were -13. So for us to close at -4, it means there are certain markets that we are able to leverage. So had we invested in Kenya alone, that would be -13. But now you got -4. So the other markets help in terms of leveraging the returns. When this particular market is not doing well, the other one is able to stabilize. So it doesn't mean if the Kenyan market is -13, because we're investing in externally, we should be at +3, because these markets tend to relate to each other. It's all about the averages that you're using. Okay, so still related to that, you mentioned about 2012, a return of 28%. I'm just curious, in the last 10 years, how many of those years have been positive for your balanced and your equity fund? About 2 years. About 2 years. About 2 years. Thank you. I can see we have a question from my namesake, Susan Kihara. Oh, there's Corey. He's asking, how are your returns compared to the market, especially the money market fund? I believe, if I'm not wrong, we are the second or the third in terms of the rates. We post these rates every day on the Nation Daily or the Business Daily. You can have a look and compare the returns. Right now, we are giving 9.3. I believe we are the second or the third after Zimele and Saiton, if I'm not wrong. Then I have a question from Susan. Is there a difference between money market funds and money market accounts? I can't quite understand the question. Maybe Susan can unmute and ask. Susan? As we wait for Susan, and Jerry is asking, sorry if I missed it, by investing with purpose, do you combine the 4 funds, or what is the value add? The value add with investing with purpose is we structure a portfolio for you. So everyone, when you talk about personal finance, it's personalized. So Jerry may want to buy a house, somebody else may want to take a vacation, somebody else would want to plan for their children. So what we do is dependent on your initial investment and dependent on your risks and return, we're able to sit down and create a plan for you, an investment plan that is within the time range that you're using and is also within the limits that you have. So as opposed to money market and fixed income where the minimums are 100, if you're investing with purpose, we do accept less than that because this is guided by how much you have and how much you're looking to invest towards your goal. So that would be the main difference. We're able to create a personalized plan for you, and dependent on your initial investment, together with your risk and return, we're also able to allocate you to the respective funds. Susan, you're in a position to clarify your question?
Yes. Sorry, I was having some technical issues on this end. Good evening.
Good evening.
My question is, if there's a, by difference, I mean the percentage of your returns on investment, some banks offer you what they call money market accounts, where you put in your money in, if I can say, like a different currency, and then they pay you an interest rate. I'm just interested to find out, is the return on that similar or less in comparison to the returns that you get from the money market funds? I hope that clarifies the question.
Okay. I think the main question would be, or the main difference would be, there's a difference between investing in a unit trust as opposed to investing maybe in an account at the bank. And the main difference is the type of interest that you're given. So unit trust, you get something called compounded interest. It means you're earning interest on the principal and on the interest. Banks, majority of the time, will give you simple interest. And when you compare in terms of returns, compound interest tends to grow your portfolio at a much faster rate. Because if we give you 10% on compounded interest, it means, for example, if 1 million is earning 7,000 in month A, month B, you'll be earning interest on 1 million plus the 7,000. In simple interest, it means in month A, you get 7% on 1 million, month B, you earn 7% on 1 million. So regardless of, your portfolio is never growing because you're getting the same interest over and over and over again. So that would be the main difference in terms of how the rate is calculated. Susan, I hope I've answered your question.
Yes, it's very clear. Thanks.
Okay. I can see Paul is asking, do you anticipate the elections and Ukraine-Russia crisis to affect the markets? That's a bit technical on my end. Not necessarily for the bonds market, since that is borrowing internally, not necessary for the stocks. What maybe would affect us would be our Kenyan elections, and they'll affect maybe a portion of the stocks because the largest portion of the shares in the NSE are traded by foreigners. So I don't necessarily think Ukraine and Russia will affect our financial markets. Maybe as other aspects of the markets that involve imports and exports, but not the financial markets.
So I have a question, and this comes from the perspective of a parent. Mm-hmm. If let's say, for example, I want to teach my child money management early on, mm-hmm. Does it, and this you're talking about somebody who is under 18, are we able to open do you call them custodial or custodian accounts, where they might open under me, but really the 100% beneficiary is the child, so that
yes,
they can know?
When you're opening an account with us, you can open either as an individual, as a joint account, or even as a company, or even as a chama, whether you're registered or not. It's just that the requirements are different. Now, when you have someone below the age of 18, the adult opens the account, but you open on behalf of the child. So even under the beneficiaries, it will be 100% the child, but the adult will be operating this account until the child reaches an adult age where they can transact the account by themselves.
So I would be registering as an individual, but in my beneficiary state, it is 100% to the child.
Exactly.
Thank you.
Might we have any other questions before we close? What I can do, I'll make sure that I send the presentation to Eve. She'll share with you. That's the catalog. I'll also type my number and email on the chat box. So in case anyone is looking to have, to create a portfolio, maybe as an individual, as a couple, you can reach us and we'll be in a position to assist. In case you're looking to invest in either of the funds, you're also able to reach us. We also have a very active YouTube page. You can take some time to go through it. We have some interesting material that would also be of value add to you individually, as a family, as a group, as a chama. Also, we've been very intentional about reaching our clients about investing with purpose, because we realized the clients that have a goal attached to their investments tend to be more disciplined, because you can see the end as opposed to investing in the wild. The goals help in terms of giving you the consistency that you need, or the discipline that you need. Elizabeth, thank you for your email. We'll share the material to you on email, unless we have any other question.
So maybe as we are wrapping up, Christine, there are a number of us who I think joined when you had already introduced yourself. So maybe just a brief background on yourself as we wrap up, for the sake of those who missed the introduction.
Okay, no problem. For those that missed, my name is Wangeshi Kihara. I'm a part of the wealth management team at Nabo Capital. Nabo Capital is a licensed fund manager by the Capital Markets Authority. In terms of my experience, I've worked in the industry for the last 7 years from CIC to ICA. So I understand both the operational side and also the client-facing aspects. From an individual perspective, I'm very motivated to spread financial literacy. We all deserve some freedom, and the freedom can come to us before 65. That's my belief. So if you're ever looking to set up a portfolio for yourself or your family, you can reach us directly or individually. Also, if you're looking for personal financial coaching, that's also okay with us. And yeah, that's about it for me.
So maybe, unless somebody else has a query, maybe this is from me. You've mentioned the personal finance coaching.
Mm-hmm.
Are there like set fees for this particular aspect, or I'm assuming you're speaking now in the capacity of if you were to do this as NABO. I know in your individual capacity, you may also offer similar services.
Mm-hmm.
So we are speaking, is there like a fee or somebody, it's a, no, not about,
No,
it's all.
No, NABO does not charge to help your client set the goals and invest with us. That's absolutely free.
Okay, otherwise, I don't see any further questions in the chat section. I'd just like to say thank you for honoring your engagement with us. I know we had a
so much
last week. Yes, but you have more than made up for the lost opportunity. So for those who are part of the community or the investable cohort graduates, I think we shall be hosting further events. I think we had shared a tentative calendar with the next event being held in March. So the dates for that will be confirmed. Otherwise, thank you very much. And thanks to the attendees also, because without you, I mean, there will be no event.
That's true. Thank you so much for the invite. And we look forward to having as many people invest with purpose as we can.
Yes. I'll be sharing the presentation once it's shared with me, and I will also be sharing Christine's contact within the group.
Okay.
Thank you. And I think good night to all.
Thank you and have a good evening.
Okay, good night.
Yes.
Good night, Eve.
Good night.
Hey, Eve.